when we have high inflation in an economy, the main job of a central bank of that country is to bring it back down.
What is some of the most important points from inflation, and how does inflation affect various other major releases?
Higher inflation usually means higher interest rates and vice versa. Low interest rates usually make loans cheaper, for example.
Does the market typically react very differently between the different releases of inflation?
Traders monitoring core and headline inflation usually also tend to pay more attention to the core inflation just because it has more weight.
How do you think that traders can exploit, or how can they attempt to predict a divergence between the consensus and the actual release?
Expectations are based on three main pillars.
Hello and welcome back to Exness Trading Talks. In this episode, we're going to be talking about inflation and how inflation can affect various other points of economic data and trading. And we're going to be looking specifically at how it can impact on monetary policy and some possible approaches to trading major inflation releases, especially from the USA. Last week, we talked a little bit about the NFP, what it means for traders. If you'd like to watch that video, you can go back and watch it from here. And I would remind you, if you haven't done so already, that it's a good idea to subscribe and turn on notifications if you want to be aware immediately when next week's episode of Exness Trading Talks is released. I'm Michael Stark, Financial Content Leader, and joining us here today to give his opinions on the topic is Antreas Themistokleous, Trading Content Specialist. Welcome, Antreas.
Hello, Michael.
Thanks very much, Antreas, for coming on. And firstly, when I would just set the context here a little bit, CPI, but I'm talking in more generally about inflation, not just consumer price index, and thinking about any other metric that you might want to use to measure inflation. That would include personal consumption expenditures as well. What is some of the most important points from inflation, and how basically does inflation affect various other major releases, and how is it affected by them, do you think?
So inflation is when we have high inflation in an economy, right? The main job of a central bank of that country, let's take the Fed, for example, is to bring it back down, right? So the way they use to do that is to hike the interest rates. So immediately inflation affects the monetary policy and Fed decision, as well as interest rates in general. So higher inflation usually means higher interest rates and vice versa. When we get lower inflation, interest rates tend to decline to inject liquidity back into the market and bring inflation back up. So that's the main correlation between inflation and interest rates.
So we want to look a little bit more at sentiment, and I would encourage you, if you're watching and you would like to know more about the specific details of how inflation influences various other releases, you can check out the article, which is linked in the description just below to find out more about that. And if you want to know more about what's going on in markets generally over the course of the week, not just inflation, I would encourage you to follow the other link in the description to sign up for Exness's weekly report. Now let's think about sentiment. How does inflation, uniquely or in the same way as other major releases of economic data, how does it affect sentiment and markets, do you think? Or how have you in the past seen inflation affecting sentiment?
Okay, so when we get higher inflation, that usually creates a spike into the bond yields, right? So when we have higher bond yields, usually the dollar strengthens, and we also get the sentiment is that the Fed will get more hawkish because inflation is high, so they need to increase the interest rates to bring it back down. Now, when we get softer inflation figures, that usually tends the sentiment to expect the Fed to become more dovish to start cutting rates, right? Because when we get lower inflation, we need that liquidity back into the market. So low interest rates usually make loans cheaper, for example, both for consumers and businesses. So that's the way they inject back liquidity into the market. So high inflation, hawkishness from the Fed, lower inflation, more dovish stance by the Fed. And also when we get lower inflation and probabilities of the Fed cutting rates, gold also gets affected because it it usually rises.
Okay, that makes sense. So if you think a little bit more about the different types of inflation, we have headline inflation, we have core inflation, we have personal consumption expenditures. In some countries, we have various others. And I mean, the differences between these usually are pretty clear. Like core, for example, is different from the headline in that usually the core excludes things with particularly volatile prices, like maybe fuel, utilities, food, spirits, tobacco. Yes, this sort of thing might be excluded.
Yeah.
But how does the market typically, well, I suppose the first question here is, does the market typically react very differently or at all differently between the different releases of inflation? And if the answer to that is yes, how does it react differently, do you think? And how has it done so in the past?
Yeah, first, you're right. Core inflation excludes food and energy because are quite volatile products, so they can keep track very easily. And because of that, the Fed tends to put more emphasis on core data rather than headline inflation because it's a more accurate, let's say, figure of actual inflation in the economy. So traders monitoring core and headline inflation usually also tend to pay more attention to the core inflation just because it has more weight on Fed interest rate policy, right? So just for that, core is usually moving the markets more than the headline inflation.
Yeah, that's fair enough. Makes sense. And we talked a little bit about expectations, that's to say the consensus, and the actual release in the last episode when we talked about the NFP. But let's think about also how that works for inflation. How do you think that traders can exploit, or how can they attempt to predict, even if possible, a divergence between the consensus and the actual release?
So expectations are based on three main pillars: analyst predictions, Fed commentary, which we've talked in a previous video how the wording goes when it comes to Fed commenting on the interest rate, and also previous data like PCE or wages, wage growth, etc. Now, how is sentiment coming into play? For example, let's think of the scenario where traders are leaning more long on risk assets, right? So when we get higher inflation data, that kills off that shift, right? On the other hand, when we have, let's say, overbuying on the bonds market, when we get softer inflation, that expedites the rally on the bond market. So sentiment with actual release plays a vital role on these scenarios, let's say.
Yeah, and I think one thing is also to think about the not necessarily correlated inputs with inflation. Like, for example, most of the time you'll find that inflation comes out about a week or sometimes less or sometimes up to 10 days after the NFP. And typically, other things being equal, the higher the NFP, the more likely it is that you're going to get an upward surprise from inflation.
Yeah.
So that's one, as obviously, like with anything else, you should not use that in isolation. You shouldn't just rely on that. But that's one thing. If you notice the NFP is a lot higher or significantly higher than expected, it's probably going to be more likely to get inflation also higher.
Usually that's the case, in theory at least.
Yeah, exactly. Yeah, do you need to combine these things into something practical? So let's look at some charts. I mean, I think maybe one obvious chart that we could look at here would be euro-dollar, just because, that's the main Forex pair. That's one of the things that's going to be very strongly affected when you get American inflation and also European inflation. Yep. So maybe we could look at a couple of examples, if you'd like, of how that actually gets affected in practice by inflation.
So on the daily chart of the Euro USD pair, we see currently a double top forming, and now the price is in a correction phase downwards. Is testing the 100-day moving average. I don't want to get into too much technical there, but the 100-day moving average is quite a significant support area on any chart, not just Euro USD. So given the double top formation and the already correcting to the downside, it's also the inside support around the mid-June. I would expect that in the near short term, we might see some short-term correction to the upside. How far can that move go? we need to wait out and see if we get a bullish correction there. On the other hand, if we see a continuation of the recent bullish correction to the downside, we might expect some support around the 1.14, which is also the medium-term low here in early June of 2025. So unless we see any major surprise on inflation or any other data like Fed policy, for example, shifting, or PMI, we're going to discuss PMI on a future video, then we might expect the current move to correct to the upside.
Okay, thanks very much, Andreas, for joining us, for being here to give your insights.
Thank you very much.
And you're right, we will indeed be discussing PMI next time. So please, we hope you would join us for that. And I'd encourage you to subscribe, turn on notifications so that you're aware immediately next week when the upcoming Exness Trading Talks about Purchasing Managers Index is released. And hopefully we'll see you there.